Good morning, everyone. Welcome back. Today, before starting our in-depth analysis, I will quickly summarize the main takeaways of this video right here, since your time is precious. Enbridge is one of America's most recognized energy infrastructure company, with a reliable business, stable financial position, and a really interesting long-term high dividend play. Additionally, when looking at this DCF model, we can see that currently Enbridge is slightly undervalued, and it can lead to really nice buying opportunities, as highlighted with the accumulation areas in the graph. Now, since the details of this model and the fundamental analysis is crucial, sit back and relax, and let's start with this video, as I can promise you will not regret it. And remember to like and subscribe if you enjoy the content, as it helps a lot and it's free to do. If you're new here, to analyze equities, I will use a 6-step valuation process, which consists of the steps shown on the slide. Additionally, the DCF model used for the price target will be available to download in the description below. So what is Enbridge? Enbridge is one of the most recognized energy infrastructure companies with 4 main divisions: liquid pipelines, gas transmissions, gas distribution, and renewable power. Liquid pipelines consist of pipelines and terminals in Canada and the US that transport and export various grades of crude oil and other liquid hydrocarbons. Gas transmission and midstream consist of investments in natural gas pipelines, gathering and processing facilities. Finally, renewable power generation consists primarily of investments in wind and solar assets, geothermal and offshore wind facilities in Europe. For industry analysis, it is important to understand the competition that Enbridge is currently facing. Enbridge's main competitors are EPD, TRP, KMI and ET in the oil and gas storage and transportation industry, as shown on the slide right now. And it should be noted that from the price-return graph, in the last year, Enbridge has done well compared to its competitors. When focusing on the main players, we can see that across this industry, there is a low compound annual growth rate for revenue growth, there are good gross profit and EBITDA margins, and we can see how Enbridge is average in most of these metrics. Enbridge has had a very good year-over-year revenue growth, however lacking in the compound annual growth rate over 3 years. Furthermore, when analyzing the dividends for this industry, we can see how Enbridge has good quants across the board with really high dividend. And it should be noted that the payout ratio is 118%, which is a red flag as it is over 100%. It's a very high payout ratio. However, when looking at the numbers, the dividend paid is $5.4 billion and the operating income, so pretty much cash from operations, is $8.3 billion. Therefore, it suggests that the dividend is well covered by Enbridge day-to-day operations. For competitive advantages, Enbridge has 3 main ones. The first is the brand awareness that they created and nurtured over the decades of operation. The second and the third, which is a strong infrastructure network that is already in place. This industry has a very high cost of entry because it's very capital intensive and it has a lot of regulatory hurdles. Therefore, with Enbridge already having a strong infrastructure network, they have a sustainable long-term competitive advantage. And finally, they have a very diversified revenue stream, as you can see in the business mix on the slide right now, between their 4 different divisions. Enbridge CEO is Gregory Ebel since January 1st, 2023. Before, he worked as the chairman, president and CEO of Spectra Energy, and before that, he was president of Union Gas Limited, and he was vice president investor and shareholder relations of Duke Energy Corporation. Therefore, he has a lot of experience within this industry. And it should be noted that Enbridge has had subpar value creation when compared to the S&P since 2017, price-wise, without including its dividend payments. There are 5 main risks present in Enbridge right now. The first is macroeconomic factors like inflation and a possible recession that will and are hitting the economy as a whole, impacting earnings growth. It has high policy and legal risks that could hinder the company's growth in the future. Thirdly, since this is a high capital intense business and Enbridge is investing a lot with very high capital expenditures, If these investments are allocated in the wrong areas and don't yield the expected returns, then it could be a major risk for the company, especially as the dividend payout ratio is above 100%. So if the cash from operations decrease significantly, then this high dividend yield will become a major problem for Enbridge. And finally, this industry is known for its high leverage with its really high levels of debt, which in an increasing interest rate environment, it could be a risk. For price target, the current price target from the DCF model is $42, and the current price is $37. On the graph, you can see the target, the two suggested accumulation areas, or the two possible accumulation areas. And as a reminder, the DCF model is in the description below in the Discord server. This is my 5-year DCF model for Enbridge, which yields a perpetuity approach value of 39, an EBIT approach value of 44, at which the average yields a 42. And when considering the current price, it creates a 12% upside. The assumptions used to get to this output is, I extrapolated the average growth rate for Enbridge, remaining at 4%. And for cost of goods sold, depreciation, and capital expenditure, I used the historical values as a percentage of revenues and extrapolated that to 2028, which yields these 2028 estimates. And using these estimates, we go back to the output, and with an applicable tax rate of 18%, a discount rate of 7%, and a long-term perpetuity growth rate of 3%, we get the perpetuity approach value. And with an conservative EBITDA multiple of 12, as the average has been between 13 and 15x, we get the EBITDA approach value. If, let's say, we were to be more bullish with a 15x EBITDA multiple, then the current upside is way higher. But let's stay conservative with a 12x EBITDA multiple, leaving a 12% current upside for Enbridge. In conclusion, Enbridge has a reliable business. It has a stable financial position. It is a high dividend play with a good track record, and it is in an industry with high barriers to entry. However, Enbridge has risks. Therefore, check risk and reward for you. But again, as a disclaimer, this is not financial advice. But personally, Enbridge at this level offer a great dividend play. However, I would wait for the accumulation areas suggested in the price target section. If you reached the end of the video, you're awesome. And if you enjoyed, please like and subscribe, as it will greatly help and support the channel. Have a good rest of your day, and I'll see you next time.